So let's now turn to how we could see this latest piece of jobs data affect how the Fed is thinking. Steven Ricchiuto is with us. He's Mizuho U.S. chief economist. Steve, it's good to see you. So obviously this is just one data point, right? We put it into the overall jobs picture. But how are you thinking about the framing of jobs right now as it relates to what we can expect from the Fed?
It's interesting you ask that question that way because, going back to when the chairman first began talking about the degree of tightening that had already been implemented and the market began discounting the fact that the Fed would pivot this year, he talked a lot about the job openings numbers. And when he was talking about that, he was trying to emphasize the reason why the Fed needed to continue to raise rates more aggressively than the market was anticipating. What you're seeing starting to happen was the scenario that he laid out, that the Federal Reserve's tightening would bring about an environment in which job openings would decline, but employment wouldn't necessarily be hit dramatically, nor would the overall level of the unemployment rate. And they were trying to suggest that they could achieve this kind of soft landing environment in the labor market by their tightening in monetary policy. And clearly the numbers that come out today kind of fit that scenario is there. We still think that the unemployment rate needs to move higher, and we think we will get into the 4.5–5% area before we're all said and done in terms of the jobless rate. But clearly the numbers that we have here showing us that the Fed's initial interpretation that we would have hiring, we would have openings come down and not really impact hirings or that matter quit rates yet is starting to come to fruition. It adds to the view that this Fed is likely to raise 25 basis points more at this week's FOMC meeting and then probably pause and assess where things go.
When we think about the employment situation, Steve, leisure and hospitality, that had still been trying to claw back or at least get back to pre-pandemic levels for such a long time. And so if there was a sector that led some of the layoffs, the discharges that then started to really show up within that unemployment rate that you were and the target that you put forth a moment ago, what would you be looking across in terms of that sector to lead that?
Well, I think one of the things you have to keep in mind about that particular sector is that COVID changed the nature of that sector. When you check into a hotel these days, you have the option of having turn down service. You have the option of having laundry service. You have the option of having new fresh towels provided versus not having any service whatsoever. And that's reduced the staffing requirements. People have gotten used to waiting longer at restaurants than they would have been before. There's certainly more tables with a lot of the outside dining relative to the staff environment. So, you've had some dynamic shifts in there, and I'm not so sure, even though we've gotten back to these levels of employment, higher levels of employment in those areas, I'm not so sure we're going to be going back to the trends we were prior to COVID because we've changed the nature of way we do some of those businesses as a result of the COVID environment.
I got to ask about a different line of business, Stephen, and the effect that it has had on the economy and the Fed, and that's banking, of course. And we not only now have the bank earnings under our belt, we also have another bank failure and seizure under our belt in First Republic. And as you think about how that's affecting financial conditions and then the Fed's job, how is that going to affect things going forward? Even if the Fed still raises rates quarter point tomorrow, what then is going to happen going forward?
Again, with regard to that particular situation, we laid out a second half recession forecast back around of Thanksgiving. And, when you'd say before Silicon Valley, I was questioning whether or not we would have a second half recessionary environment. Clearly, what's happening in terms of a reduction in bank liquidity, which will probably come out from the senior loan officer survey this afternoon, you're going to see that bank liquidity is going to contribute to a recessionary environment. But it's not a systemic credit crunch. It is a credit crunch where we're basically reducing the amount of liquidity in the system. We're not drying that liquidity up. And the net result is the impact will probably increase a second half recession, which is why I was talking about the fact in terms of the labor market that we're going to get back to that 4.5 to 5% level on the unemployment rate from the 3.5% level we are right now. That's a nice particular deterioration, but it still leaves us in a very, very healthy labor market environment relative to many other business cycles.
Steve, this might be too much of a futures type of question, but I suppose because we're seeing the news around around companies like even IBM saying that they're going to pause hiring in some of the plans that they have, at least, because AI can do roles that they're thinking about in the future. This could impact more than 7,000 jobs is what they're projecting at this point. And so that considered, how far off are we until we see some type of artificial intelligence input that trickles through to either job openings or broader employment situation data?
Yeah, that's unfortunately an imponderable. I heard the IBM announcement myself this morning and scratched my head. You know, when I look at those kind of situations, remember, IBM is a company that has been a mainstay in the computer industry since I was a kid, and it continues to be a mainstay. But it is not the leading edge of the growth engine in terms of the tech industry, and that's where the jobs get created. It's the leading edge of the economy that creates the new jobs. Companies that have been around for a long period of time, they go through these kind of environments. They can't keep on innovating. They can't keep on pushing the top line. So the way they drive the earnings number is by reducing the cost structure. Again, nothing against IBM. It's just the nature of the beast. And I think in this particular environment, that's kind of what we're seeing. They're looking for ways to juice earnings in an environment where the world is kind of moving away from them.
And Steve, if we're looking at, these kinds of pressures coming to the fore, as well as what you described as that shallow recession, for lack of a better word, what is that going to feel like in the second half of the year for regular Americans?
Yeah, I mean, to be honest with you, the type of deterioration we're talking about in terms of the labor market is really not going to be a frightening environment for the average American. Yes, some people are going to lose their jobs. There's no doubt about that. Going from 3.5% to 5% on the jobless rate is going to have an impact. People will lose their jobs. But we're not talking about an environment where consumer liabilities become a systemic issue for the banking industry, where there is wholesale default, where there is a concern about underlying creditworthiness of the consumer sector. You know, we're right now at a position where a couple of the financial institutions that lead the edge in terms of consumer lending are saying, you know, we're just back to 2019 levels on consumer defaults. And we got very upset at them for having said that. 2019 was an incredibly healthy year for the economy and the consumer. And therefore, you know, we're starting from a very, very solid base in terms of consumer financials. Yes, there'll be some deterioration from here, and I feel sorry for the people who are going to experience that deterioration, but that deterioration is going to come nonetheless.
Yeah, definitely something to continue to watch. Steven, thanks for your perspective this morning. Steven Ricchiuto is Mizuho chief economist for the U.S. Thanks.